Hello and welcome to this edition of Taking Stock for the week ending the 14th of February 2025. I'm Kien, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to break down all things share market. It's been an interesting week, Matt, in the world of investing, and there's quite a lot to discuss. How are you today?
Yeah, I'm doing very well, and it's the first time back on taking stock for this calendar year 2025. So it's a pleasure to be joining you.
Yeah, when so busy time to join us, Matt. But it's great to have you on board and hit the ground running. But before we dive in, just a quick yet important reminder: the information we share today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so past performance figures shouldn't be relied upon as a guide for future performance. Well, Matt, let's get started. This week, we've seen the Australian share market hit new highs, and the catalyst for these gains has largely been that earnings season, which has been solid in terms of the results across the board in general. However, it's been a bit different story in the US, where concerns about sticky inflation are starting to weigh on the market. For example, the core inflation rate in the US was up to around 3.3% in January, and that's coming from 3.2% the month before.
Yeah, that's right, Ken. Although, look, inflation has generally trended in the right direction, the core inflation rate has been stuck slightly ahead of the Fed's target level. And this has in recent weeks prompted Jerome Powell to moderate investor expectations on the level or number of rate cuts to expect in 2025. And adding to that is the Trump administration. They're continuing to keep everybody on their toes in the investor world as he uses threats of tariffs to negotiate new trade agreements. But all that said, the US earnings season has once again been extremely solid, with about 77% of companies reporting results that have exceeded the market's expectations.
Yeah, definitely. But let's shift now towards the Australian reporting season, where we saw results from some major players, starting with the Commonwealth Bank of Australia this week. They reported a 2.3% rise in cash profit and a 5% increase in their dividends compared to last year. Naturally, these results spark optimism about the Australian economy, particularly given that bad debts are now under control still, and net interest margins, which is the difference between loan rates and deposit rates, they've remained quite strong. So the market seems very excited about the outlook. Matt, what's your take on this?
Yeah, another strong result for CBA, isn't it, Ken? And look, I think the market is right to be optimistic in many ways, but there are some important caveats I think we should all consider. So while the bank has been a strong performer in some areas, competitive pressures around loan and deposit pricing remain quite intense, especially in the face of rising costs. Interestingly, the CEO did mention that the mortgage competition appears to be stabilising somewhat, which could help protect margins moving forward. However, there are some analysts in the marketplace that have raised concerns about the valuation of CBA, especially when you consider that its dividend yield is only around 4.1%, which is quite similar to what you'd expect to get from a term deposit without taking on any of the equity risk. Furthermore, expenses, as we mentioned, have jumped about 6% due to rising staff costs and investments in artificial intelligence technology.
Yeah, very interesting, Matt. There's certainly a few risks there to keep an eye on still. It's worth noting that CBA still has approximately around 700 million left of their previously announced 1 billion share buyback, which could provide an added boost to earnings per share and also dividends per share in the near future. With the stock up around 50% over the past year, it makes sense for some investors to take profits if the exposure is becoming too concentrated or large. In the meantime, the stock is expected to go ex-dividend next week on the 19th of February, 2025.
What a year it's been for members that have been invested in CBA all year. But
Mm.
moving on to another major Australian company where fortunes haven't been so good, CSL. The company has faced its fair share of headwinds recently, including setbacks with its clinical trials in the US and competitive threats from generic alternatives in Europe. And there's also that impact of rising costs, which is affecting most companies. But the company's results for the half year were a little bit disappointing, unfortunately, with revenue from some of its key divisions in Seqirus and Viafor falling short of expectations.
Yeah, that's right, Matt. One of the contributing factors to these results was the declining flu vaccine uptake following COVID-19 pandemic, which is still flowing through. But despite these challenges, CSL has done a good job addressing investor concerns around cost inflation. The company was able to improve its profit margins and return on equity, which is a positive sign there.
And looking ahead, CSL has reconfirmed its full-year guidance, which is a positive, and its Behring division, which focuses largely on plasma-derived therapies for autoimmune diseases, continues to perform strongly, and it does account for about 2/3 of the total revenue. The company also expects vaccination rates to rise again, given the severity of the flu season in the US this year. So while the short-term outlook may remain a little rocky, the positive earnings trends suggest that long-term investors might find an opportunity here if the share price continues to weaken.
Yeah, indeed, Matt. And currently, not surprisingly as well, the stock is trading at a discount to its fair value. So that could be due in part to this ongoing uncertainty around Donald Trump's tariffs on pharmaceutical imports as well. However, CSL has indicated that it is well positioned to manage these risks, as it's got quite a diverse manufacturing footprint across the US, Europe, and Australia. And it seems that the company is prepared to adjust its supply chain to mitigate any potential tariff impacts by moving away from China towards the other parts of the world.
And moving our attention again to another global company listed here in Australia, Breville Group. The coffee machine maker has defied expectations, especially in a retail environment marked by consumer caution and broader discounting trends. Despite the challenging backdrop, Breville was able to improve its return on equity and profit margins.
Yeah, that's right, Matt. A few factors contributed to this success. For one, the company managed its operating costs quite effectively. They also launched new products which help drive margin improvement. On top of that, the rising cost of coffee beans has motivated more consumers to brew their own coffees at home, which likely boosted the demand for Breville's products as well. Additionally, the company has expanded into new markets like China and the Middle East, which should provide some diversification for future growth.
And despite many of these positives within the result, Breville has warned about the impact of ongoing uncertainty around the US and China trade relations and the potential for continued higher tariffs. The company earnings outlook has been revised to between 5 and 10% growth for the full year. So we do expect an adjustment to the earnings revisions under Golden Rule number 3.
That's a good point, Matt. Breville has acknowledged that around 40% of its sales are exposed to the risks of the US-China trade war. However, the company has taken proactive steps to address this exposure, including the shifting much of its production out of China and hedging against tariff costs by stockpiling inventory into the US to minimize this impact.
And a few other notable results this week. We've seen updates from companies like Pro Medicus, Computershare, and Treasury Wines. So stay up to date on all the latest changes and commentary. I encourage you to check out Star Stock Update section on the Stock Doctor platform.
Yeah, not to mention Matt Cochlear just released their results this morning, which missed expectations, and they did revise their earnings guidance towards the bottom end of their range. But stay tuned for our review on this one. And looking ahead, next week we'll continue to see the reporting season pick up. We're keeping a close eye on Macmillan Shakespeare, also Spark New Zealand, and Step One, some of the more interesting names that's facing significant challenges recently. For example, Macmillan, there's been some added pressure of broker downgrades, political uncertainty, and the potential loss of contracts to competitors. Make sure to check out our strategic comment for full details. Now for this week's Under the Microscope segment, let's take a look at Suncorp, the general insurer and star income stock. What makes Suncorp particularly interesting right now is the company is returning the proceeds from the sale of its banking business to its shareholders. And this includes a 3% per share capital return, a 22-cent per share special dividend on top of its regular interim dividend of 41 cents per share. And all this translates to an annual gross dividend yield of around 9%.
Yeah, lovely little boost in income from the Suncorp sale of that ANZ division, isn't it, Kien? And many of our clients will be very, very happy with the $3 capital return, which will be a cash payment to shareholders and also accompanied by a share consolidation. And this will help adjust for the impact of the capital return on the share price. Both the capital return and special dividends will be paid alongside the interim dividend on March the 14th.
Yeah, and to benefit from this, again, you had to be an investor by February the 14th. So unfortunately, the window has closed here, but beyond the dividend return, how is the insurance business performing, Matt?
I thought Suncorp delivered a really impressive half-year result, with its cash earnings up 30% year on year, beating expectations by some 11%.
Mm.
And this was driven by favourable claims environment and strong investment returns, which is all translated to an annualised return on equity at around 11%, with profit margins of 12.
Yeah, and with regards to its outlook as well, its key performance metric, it's called the underlying insurance margin. That's trading at the top end of their 10 to 12% guidance range. No doubt the earnings beat will contribute to positive earnings revisions over the next few days. And earnings should also benefit from mid to high single digit growth, written premium growth, along with a decline in operating costs. And with the payout ratio expected to be between 60 to 80%, this should translate to a steep improvement in dividends for the full year. And what about the risks, Matt? For example, how would the Northern Queensland floods impact its profitability and also its future dividends?
Yeah, inherent in any insurance company, isn't it, Kien? And
Mm.
it's difficult for Suncorp to quantify because the insurer has limited access to the flood-affected regions. However, the CEO has insisted that the floods will not dent full-year profit and threaten the allowance it has set aside, nor will it have an impact on premium or reinsurance costs. So as a result, Suncorp has reaffirmed its premium growth guidance at mid to high single digits for the full year.
Yeah, they do appear to have enough provisioning or allowances set aside for these events. For example, in the first half, the total cost of natural disasters was only around 503 million, well below the 780 million it has set aside for the period. And with plenty of capital, there is scope for the business to also conduct a share buyback in the second half. So we believe dividends remain sustainable moving forward for now. The reporting season is a time when there are many star stock changes. So a useful question, particularly for some of our newer members, is how can members keep track of all the star stock changes over the last month, Matt?
It's a good question. It's so important at this time of year. So to keep track of star stock updates and any company announcement, clients can refer to the latest star stock updates section under the research homepage. To get more detail on this, click on View All, and it will take you to the recent updates and announcements page. You can also access this page under this Tools heading and clicking on Recent Updates. Here you'll be able to monitor star stock recommendation changes by selecting all companies, choosing a time frame, say 3 months, and then select star stock recommendation changes. And the tool will then provide you with a list of all star stock changes.
And you can also identify star stock changes under the Alert Manager. Here you'll be able to set star stock change alerts and have the option to process this intraday or receive the alert via email. And the Alert Manager also allows you to monitor other changes, including earnings revisions, director holdings, ex-dividend dates, and also technical breaches, such as when the share price breaks through the SD30 TSR. Also, make sure you set your email notifications on so you don't miss out on all the commentary and our star stock initiations as well. But that's all we have time for today because of such a busy period now. But thanks, Matt. I know, you've been very busy as well, but, appreciate you coming in today.
It's that time of year, isn't it, Kien? And good luck to everybody out there for the remainder of the reporting period. But if you do have any questions in the interim on any of the results that have just gone by, join us for Lincoln Live on Monday morning.
Yeah, or feel free to contact us if you need any assistance there. And reporting season ramps up next week. So make sure to update your portfolios and set your watch list and alerts to track any changes. In the meantime, take care and have a happy, healthy, and prosperous week ahead.